16 videos, 11 hours, 13 minutes of your time. This was the week Michael Saylor broke his golden rule, and Wall Street loved it. Elon Musk pulled off a 200 IQ deal that nobody saw coming. Anthropic dropped infinite context windows and agents that dream in their sleep. Jensen told the world to raise their ambition by 100x. And Chamath went on Rogan for 3 hours to explain why Bitcoin is the new risk-free rate. If you're building a business, investing your own money, or just trying to stay ahead, this is the episode. 5 clusters, 16 videos, everything that matters. Let's go. Michael Saylor just did something he said he'd never do. He announced that Strategy is willing to sell Bitcoin. Cue the panic. The headlines screamed death spiral, Twitter melted down, but here's what actually happened and why it's genius. Strategy holds $60 billion in Bitcoin. Their dividend obligations on STRC, a fraction of that. And Bitcoin only needs to appreciate 2.3% per year to fund those dividends indefinitely. 2.3%. Bitcoin did 60% last year. The real play is financial engineering. They can sell high-cost basis Bitcoin, harvest the tax loss because wash sale rules don't apply to digital assets, and immediately buy it back. They get a tax credit and keep the Bitcoin. CEO Fong Lei called the balance sheet bulletproof. $60 billion in Bitcoin, $2.25 billion in cash, 18 months of dividend coverage without selling a single sat. 5 videos covered this from every angle. The consensus? This isn't Saylor getting scared. This is Saylor building a capital machine for a structural supercycle. You're alpha. If you hold STRC for the yield, nothing changed. The dividend is covered. If you hold MSTR common, watch Bitcoin per share. That's the metric that matters. And if you're an entrepreneur using leverage, study how Saylor manages optionality across his capital stack. It's a masterclass. The Hurdle Rate podcast dropped what might be the most important Bitcoin finance episode of the year. Their thesis: Strategy isn't a Bitcoin holding company. It's a financial engineering platform that uses Bitcoin as hard collateral for layered securities, preferred equity, dividends, digital credit instruments. They walked through the math. Strategy is retiring 90% of its convertible debt, replacing it with perpetual instruments that have no maturity date. No death spiral risk. No forced liquidation. The host compared it to the insurance industry. Variable rate, perpetual preferred equity is how insurance companies have operated for decades. Strategy is just doing it with Bitcoin as the underlying asset. Their prediction: financial products like ETFs and digital credit, not self-custody, are Bitcoin's true killer app for institutional adoption. And if that ecosystem scales, the underlying asset has to reprice dramatically. You're alpha. Traditional risk-free assets don't exist anymore. U.S. Treasuries yield less than fiat debasement. STRC at 11.5%, paid monthly, tax-deferred, is how the smart money is solving that problem. Not financial advice, but it's worth understanding the structure. Elon Musk just pulled off one of the most audacious moves in tech history, and almost nobody's talking about what it really means. He dissolved XAI into SpaceX, created SpaceX AI, then turned around and subleased Colossus One, over 220,000 NVIDIA GPUs, to Anthropic, moved his own Grok training to the bigger Colossus 2. Why? Because SpaceX is heading toward an IPO, and Musk just turned it from a rocket company into an AI infrastructure company. Think about that. SpaceX already has a near monopoly on affordable space launches. Now it's also a compute provider leasing GPU clusters to the hottest AI company on the planet. And Musk added a good for humanity clause, meaning he gets to decide which AI companies can scale on his infrastructure. 2 videos broke this down. Both reached the same conclusion: compute access is the new strategic moat. The entity that controls scarce infrastructure gets to design the products, financing, and customer relationships built on top. You're alpha. Don't just watch AI model benchmarks. Watch who controls the compute. SpaceX IPO isn't a space play anymore. It's an AI infrastructure play. And if you're building AI products, your compute supply chain just became a board-level conversation. Anthropic had their code with Claude event this week, and they dropped 4 announcements that matter. First, infinite context windows. Claude can now process entire code bases, hundreds of pages of documentation, without losing the thread. No more chopping your project into pieces and hoping the AI remembers what you said 3 prompts ago. Second, dreaming. This is the wild one. After Claude finishes a coding session, it goes back and reviews what it did. Finds its own mistakes, generates new memories and strategies, then applies those improvements to the next session, an AI that gets better while you sleep. Third, managed agents, multi-agent orchestration, where a lead AI delegates work to specialized sub-agents. You define the outcome. Claude figures out how to get there. Think, a virtual engineering team that runs 24/7. Fourth, they doubled rate limits for Pro, Max, and Enterprise, powered by that SpaceX compute deal. Boris Cherny from Anthropic went on stage at Sequoia's AI Ascent and said something worth tattooing on your wall. Coding as we know it is solved. The competitive edge isn't writing code anymore, it's knowing what to build. Domain expertise beats pure engineering. Your alpha. If you're a founder with deep domain knowledge but limited coding skills, your window just got wider. These tools turn one person with taste and judgment into a 10-person engineering team. Learn Claude Code, learn agentic loops. That's your leverage. Jensen Huang showed up at the Milken Institute and did what Jensen does. He made everyone in the room feel like they're thinking too small. His core message, the transition from generative AI to agentic AI requires 1,000 times more compute power, not 10 times, not 100 times, 1,000. Because agents don't just generate text, they reason, plan, use tools, and take action in real time. He introduced physical AI. AI moving beyond screens and into the physical world. Manufacturing lines, healthcare equipment, autonomous vehicles. He called it several $1 trillion of reindustrialization. On CNBC, he sat down with ServiceNow CEO Bill McDermott and dropped another bomb. Service is software. Software is service. The service industry is 100 times larger than the software industry. Agentic AI unlocks all of it. 3 videos covered Jensen this week. Every one of them reached the same conclusion. We are compute constrained. Demand is exponentially outpacing supply. And NVIDIA's product roadmap stretches through 2028. Your alpha. Jensen's advice. Whatever your level of ambition, multiply it by 100. The tools are here. The infrastructure is building. The question is whether you're thinking big enough. For investors, NVIDIA at current multiples with this demand curve, that's your call. But the demand is real. Chamath Palihapitiya went on Joe Rogan for 3 hours and covered everything. The headline, Bitcoin is the new risk-free rate. If your investment can't beat Bitcoin over 5 years, you shouldn't make it. He argued that the economic compact between labor and capital is broken. Capital gains are taxed at a fraction of wages, and that AI will make traditional labor taxation untenable. His solution: shift the tax burden to corporations and incentivize them to fund public goods directly. Think Carnegie Libraries, but at tech scale. On AI, he was blunt. The concentration of AI power among a few global entities is the defining risk of our time. But the opportunity for entrepreneurs is equally massive, if you understand the second-order effects. His most provocative claim, in a post-scarcity world enabled by AI and UBI, purpose and meaning become the scarce resource. The entrepreneurs who figure out how to deliver that, not just products but purpose, will build the next trillion-dollar companies. Your alpha. Chamath's framework is simple. Invest in scarcity. Bitcoin is scarce, compute is scarce, purpose is scarce. Everything else is getting cheaper. Position accordingly. The last cluster is about what's happening behind the scenes in AI deal-making. CNBC's coverage from Napa highlighted that the AI investment thesis has evolved. It's not just about chips anymore. The money is flowing into power generation, cooling systems, fiber optics, natural gas, the physical infrastructure that keeps the AI factories running. Jim Cramer made an interesting call. As AI shifts from generative to agentic, CPU demand will surge alongside GPUs. The hardware landscape is about to rebalance, and restaurateur Mario Carbone showed up with the counterpoint nobody expected. Even in a cautious economy, consumers pay premium prices for experiences. His high-end restaurant group is expanding globally through hotel partnerships. The lesson? AI will commoditize products. Experiences resist commoditization. Your alpha. Look for second derivative AI plays, not the models, the picks and shovels. Energy, infrastructure, cooling, packaging, and if you're building a service business, double down on the experiential elements that AI can't replicate. Culture, atmosphere, human connection, that's your moat. Here's your playbook from this week's 16 videos. 1. Saylor's not selling, he's engineering. Study the capital stack. STRC dividends are covered. Bitcoin per share is the metric. If you hold it, sleep well. 2. Compute is the new oil. SpaceX, Anthropic, Nvidia, they're all fighting over the same scarce resource. Watch who controls infrastructure, not who has the best model. 3. Coding is solved. Domain expertise wins. If you know a market deeply, the AI tools now exist to build the product yourself. Claude Code, agentic loops, managed agents. Learn them. 4. Think 100 times bigger. Jensen's not being motivational, he's being literal. The tools that existed for teams of 10 now work for teams of 1. 5. Invest in scarcity. Bitcoin, compute, purpose, experiences. Everything else is deflating. That's episode 13 of Ask Lucky. 16 videos, 11 hours, summarized in 13 minutes, so you can get back to building. If this saved you time, hit subscribe, share it with a founder who's drowning in content, and drop a comment. Which cluster hit hardest this week? Saylor's Capital Machine? Claude's Dreaming Agents? Jensen's 100x Challenge? New episodes drop every week. I watch the podcast so you don't have to. Stay curious, stay building, and remember, the chairs are empty and the tools are here. It's your move.